Level 1. Core Thesis. There is a machine. It runs silently. Most people turn it on without knowing what it does. By the time they understand, decades have passed. Some end up wealthy. Others end up architects of systems they can no longer escape. This is not about getting rich. This is about what happens when compounding becomes invisible. Level 2. The hook. You have $4,200 in a savings account. It sits. You think it's safe. Meanwhile, your bank uses that capital to underwrite a $340 million commercial loan. They pay you 0.4% annually. They earn 6.2% on the same money. You never see the difference. Every 2 weeks, your paycheck lands. You spend 80%. You save the rest without thinking. Someone once mentioned compound interest in high school. You nodded. You didn't ask questions. Now, you open a high-yield savings account, 4.5% APY. You set a $200 monthly transfer. It runs automatically. At year-end, you've earned $89 in interest. You stare at the number. It feels small, disappointing even. You're right to feel that way. But the $89 was never the point. You just activated a mechanism. And mechanisms don't care about your opinion. They just run. Level 3. Problem layer. You are not an investor. Not yet. You are a depositor. That distinction matters more than you realize. You open a brokerage account. You choose an S&P 500 index fund. $500. You press confirm. Your hand shakes slightly. You've heard the statistic before. 10.5% annualized return over 80 years. Now it's your money inside that number. You enable automatic dividend reinvestment. Every payout buys fractional shares immediately. No thought required. Month 1. $500 invested. $1.40 gained. Month 12. $6,300 invested. $180 gained. Then the market drops 6% in 4 days. Your portfolio loses $378 overnight. You stare at the red number on your phone. Your thumb hovers over the sell button. Your heartbeat accelerates. You stop. You put the phone face down. You breathe. You hold. Someone on Reddit says you made the right call. You feel proud. You shouldn't need external validation, but you're still learning what discipline actually costs. Level 4. System exposure. You open a calculator one night. $500 monthly, 40 years, 10% return. The output, $3.16 million. Something shifts. Money is no longer something you spend. It becomes something that works. Every dollar you invest begins replicating itself. It doesn't rest. It doesn't ask permission. It just compounds. You are an investor now. The machine is accelerating. You begin to see what you built. Your portfolio hits $47,000. You track net worth every Sunday evening in a spreadsheet. You max your Roth IRA. $7,000 annually. Tax-free growth forever. You contribute exactly enough to your 401k to capture the full employer match. Not a dollar less, not a dollar more. You read that a 1% expense ratio costs you $360,000 over a lifetime on a $500,000 portfolio. You switch to Vanguard. 0.03% expense ratio. You never look back. Your allocation. 80% equities, 15% bonds, 5% international. You rebalance quarterly without exception. A friend asks how to start investing. You give them the boring answer. Automate. Diversify. Don't touch it. They want to hear about crypto or options trading. You tried that once. You know exactly what it cost you. The insight isn't a new investment. The insight is time. Compounding doesn't scale in a straight line. It accelerates. The first $100,000 takes 8 years. The next takes 4. The one after that takes 2.5. At some point, your portfolio earns more in a quarter than your salary does in a year. Nobody claps. There's no ceremony. Real wealth is invisible. It rewards discipline in private. Level 5. Psychology layer. You are no longer just investing. You are optimizing. Your net worth crosses $400,000. You don't celebrate. You open a spreadsheet and recalculate your projections. Capital is accumulating faster now. Your job is simple. Don't interfere. The Fed raises rates aggressively. Your portfolio drops 19%. You lose $76,000 on paper in 6 weeks. You add $600 that month anyway. You buy into the dip. You tell no one. You just execute. Building wealth is boring. It is invisible. It rewards discipline with no external signal. No likes, no applause, no feedback loop. You move beyond index funds, municipal bonds for tax efficiency, REITs for real asset exposure and yield. You stop thinking in annual returns. You think in decades now. The calendar means nothing. You have a 12-month emergency fund. Insurance is airtight. Estate documents are signed. Beneficiaries are listed correctly. People start calling you lucky. You don't argue. You know exactly what it took. It wasn't luck. It was correct decisions made consistently over time with no audience and no applause. The machine is running faster. You can hear it now. It no longer needs your attention to grow. You are a wealth builder. The next level doesn't open with effort. It opens with a threshold. Level 6. Strategic shift. Your net worth passes $1.2 million. The system changes. New doors open quietly. You are now an accredited investor under SEC Rule 501. The private markets appear. A private equity co-investment opportunity arrives via email. $50,000 minimum. 5-year lockup. Projected IRR 22%. You read the full waterfall structure. 2 and 20. The GP takes 2% annually in management fees. 20% of profits above an 8% hurdle. You read every page of the private placement memorandum. Then you wire $50,000. No hesitation. You enter a private credit fund. Senior secured loans at floating 12%. Quarterly distributions. Completely illiquid. You understand the risk premium now. You're being compensated for surrendering liquidity. That's the trade. Most personal finance content never explains this. Above a certain threshold, the instruments change entirely. Your portfolio now generates returns through 4 mechanisms simultaneously: equity appreciation, dividend income, private credit yield, depreciation tax shields. You are not playing the same game as someone at level 2. The board is entirely different. It wasn't hidden from you before. It just required capital to access capital. Now you have both. You are a capital allocator. The next level doesn't ask what you want. It asks who you know. Your net worth hits $6.4 million. You say it to yourself once. Then you stop saying it. You contact a multifamily office. Minimum to engage, $5 million AUM. They offer pre-IPO access. Structured notes with principal protection. Hedge fund allocations closed to outside investors. You listen carefully. Your effective tax rate this year is 11.3%. That didn't happen by accident. It took 6 weeks of planning. Opportunity zone deferrals. Charitable remainder trusts. Stepped up basis strategies. A Delaware statutory trust holding structure. All legal. All documented. The wealthy don't just have more money. They access a completely different financial infrastructure. Your children have 529 accounts, each seeded with $150,000 at birth. At 7% over 18 years, Each account becomes $512,000 before they finish high school. This is architecture, not just building wealth. Building wealth that builds wealth for people not yet born. At sufficient scale, compound interest stops being personal finance. It becomes structural power over time. You stop checking returns years ago. The machine doesn't need observation to keep running. You are the architect now. The next level has no name on the door, but you already know which building it's in. Level 7. Cinematic Resolution. Your family office manages $40 million in assets. You stopped counting long ago. You sit on 2 private company boards, not because you pursued it, because capital at this level creates proximity automatically. You co-sponsor a venture fund, $20 million committed over 3 years. Your name is on the term sheet, not on the press release. You have dinner with a former deputy treasury secretary. You didn't arrange it, someone else did. That's the entire point. You didn't seek power. Capital at this scale generates proximity to power whether you want it or not. Compound interest is no longer a personal finance tool. It is a mechanism of economic stratification. The returns you earn, the private premiums, the tax efficiency, are partially subsidized by access others cannot reach. When the market drops 30%, you have liquidity, time, and insulation to treat it as a buying event. People without your buffers panic sell at the bottom. Their loss flows through the system. Some of it reaches you. The system isn't broken. This is exactly what it was designed to do. You've always known this. You know people who call themselves friends. You're no longer certain the word means what it used to. You are a systemic participant now. The next level isn't a room. It's a structure. And it has no ceiling. You are not an individual anymore. You are a trust, a holding company, a foundation, a limited partnership. The foundation holds $200 million in assets. It earns 7% annually. It distributes 5%. It retains 2%. The foundation never spends down. That 2% re-enters the principal. It grows forever. The name on the building is not your name. It's the name on the trust. You prefer it that way now. Your great-grandchildren will be accredited investors at birth. The compounding began before they existed. They will sit on boards because the family name carries weight accrued over decades of structural compounding. Compound interest doesn't just grow money. At scale and time, it converts capital into legacy, into institutions, into privacy, into optionality, into freedom. It also costs things: intimacy, trust, authentic human connection. You traded them one at a time. You didn't notice until it was too late. You stopped checking returns years ago. The machine doesn't need you to run. It never did, not really. The compounding at this level is not personal, it is structural. It operates without your name, your presence, or your attention. The machine doesn't need you anymore. It hasn't needed you for a very long time. This is the destination. Somewhere across the city, a 23-year-old walks into a glass tower for the first time this morning. He opens his first brokerage account on his phone during lunch. He sets up a $200 automatic transfer. He feels smart. He thinks this is about financial security, about retiring comfortably, about building a better life. He doesn't know that the $200 isn't the point. The mechanism is the point. It was always the mechanism. But he will.